Hello and welcome to the Golden Thumb Rule, the podcast where we decode timeless investing principles with market experts so that you can cut through the noise and focus on what truly matters. Well, I'm your host, Kshitij Anand, and today we're diving into the topic that every retail investor should master, that is, framework for investing. And who better to guide us than our guest, Nitin Bhasin, who's head of institutional equities at Ambit Capital. Now, Nitin has been at the foremost of tracking market trends, evaluating businesses, and helping investors make smarter decisions. Nitin, welcome to the Golden Thumb Rule.
Thanks, Kshitij, for having me. Thank you.
Thank you so much for taking the time out, Nitin. And let's start with the big picture. India seems to be at the inflection point with the AI disruption, the rise of new age companies, if would say that, a surge in IPOs, and shifting investor behavior. So, how do you see these forces shaping our markets over the next few years?
Yeah, Kshitij, this is that kind of a question one can keep on discussing at length for hours. I think, ours is a country which is continuously under development. We're all work in progress, and every time you travel, you see many things happening. But sticking to the question that you asked, right? I think, the big thing that's changed in India is the entire acceptance of risk taking. And that is visible in what's happening in the equity markets in India, a country which was obsessed with physical savings, whether it was gold or whether it was real estate. And you can see now the number of demat accounts and the unique demat accounts, which means that, you've got so many people ready to put in money. And not only that, if you were to travel across the country, you can see people investing in angel investing, venture, family offices from smaller cities like Raipur, Patna, Indore come up. It shows you that it's not only the IPO boom, but underlying factor is now the land of India is becoming a land of opportunities and land of entrepreneurs and a land of funding availability also.
Exactly.
Earlier, we were dependent upon the global funding. I think that's one of the big things. I think the new age, the word that you use, perhaps I would say go back to new age starting about 25 years back in India when the telecom communication or the telecom revolution started. Perhaps at that point in time, cell phone was just voice communication. And now, with the data rates being so low and Indians being using data so, you could say, humongously for such cheap data rates, it actually tells that awareness of global trends, awareness of trends happening in metro cities, in smaller cities, and alongside people actually choosing to consume wherever they live rather than going on a special destination. So I would say, look at new age companies, they're actually bringing the data footprint of not only the rich people of the country, but also the middle class, the rural middle class, the poor. Data is available. So I would say we've only seen early days of new age companies. The next 5 years could be the new age companies, which will be built around data of Bharat, not only the data of the top 50 million users of India. You also mentioned AI. I think AI is a overused word in everything. I think at the same point in time, what I noticed is it is a reality where everybody will have to learn. Like we all learned English, we all learned how to use Excel. We all have to learn how to use certain AI tools. Good part is an AI tool can be conversational. You don't have to necessarily learn an Excel or the formulas in Excel, etc. But that will become part of life. As I was listening to one of the investors globally talk about it, that refrigeration led to Coke become successful. Could AI be that refrigeration to lead to new business models come up? And I will close this shifting landscape in India, which I in the beginning mentioned about how risk appetite is creating capacity of capital in India. And after that, how we are seeing the new age making data to business, and then AI perhaps making it much faster for multilingual society and country that we are. The fourth one I would say is the big thing that is playing on in my mind is how India is becoming a very connected country from a very disconnected country, multiple networks of as basic things as roads, electricity, aviation, and information about individuals and their spending behavior uh, is gathering pace. And that's actually making India a much more interesting place and more connected market for somebody to build a pan-India national business, or also if they want to do selective audience business for that. You can see Amazon and Flipkart are thriving in that.
Now, let me also quickly go on to my next question. In such fast changing times, the temptation is to chase trends, but you've always advocated for principle based investing. What do you think these timeless rules matter more than every you could say at this point in time more?
I think one of the most important things, we all talk about how we choose companies, but I think as the hair is becoming gray and you're meeting more companies and meeting more investors, I think the first thing that stands out, which is underappreciated in the beginning, is valuations. Valuations are like gravity on Earth. Am I right? You can actually have a velocity. You need to go wherever. You can bend the best ship, but you can't actually escape gravity. Escape velocity is very far and few. Escape gravity doesn't exist. In valuations is that sort of a thing called gravity. But we also know that it's a function of demand and supply. India has seen one of the big changes, which is a typical business trading at 16 times, maybe trading at about 36 times today, because the supply and demand is different, and that's changed. Regime changes in the multiple. I think the first is never lose sight of valuation. But the question is, what is valuation? In the way we look at it, valuation is what is possible. Imagine for a particular company that how their management that you have today, the compared advantages that you have today, tomorrow's opportunities that could arise in that industry, and what can this management and the today's compared advantages exploit tomorrow's opportunity and hence deliver on growth. And then that shows you the possibility of these businesses. Discount them to today and you get a valuation. I think otherwise the 16 times, the 26 times, the 36 times has no meaning. The first thing is, as I said, valuations, which are connected, is focus on the quality of the management. How have they behaved in the times of change in the past? Have they built a business on the base of balanced risk taking or complete risk avoidance? How do they do trial and error? How do they go out and question themselves yesterday for a different tomorrow? Which leads to compared advantages either becoming stronger or weaker for tomorrow. We don't want to invest as investors. We don't want to advise as analysts. We invest in yesterday's compared advantages for tomorrow. I think that's so. Hence, management quality, compared advantage, and then our last thing is many a times we are trying to be crystal ball racers over here,
right?
So an investor should always think about the past behavior of the management, but past report cards also. Can I trust the accounts of a company?
Right.
The numbers make sense. Does everything sense right in these numbers? Because investing is easy, but it is not simple, or the other way around. Investing is simple, but not easy. You can choose. The question is, once you build those frameworks, so I would say timeless principles always remain: valuation, the man behind the company, whether it's a large bank like an Axis Bank, which has gone through the leadership change and become very different, or for that matter, a small company. You've seen Page, you've seen examples of that, how promoters have built businesses in a different altogether, Shree Cement, altogether different. And then compare advantages for tomorrow, not for today.
Yeah.
Last bit is a look at their track record of accounting quality. And then they've got sub-segments within all of these four principles. Right. At a very high level, investors should focus on these four things.
Let's also quickly touch upon one of the things that you said, if your skill can be automated, it probably will be. Well, that's a sort of a wake-up call for some professionals as such, and even investors, they should also prepare for the AI-led future. And so, according to you, what's the golden rule here? How should investors go about it right now?
I think, as I said in the beginning, AI is a tool. Very similar to a tool, let's say perhaps 20 years back when we all started using Excel. Otherwise, many times numbers were done on, let's say, calculators or on mental math basis, etc. What's the market cap, what the company could become. I think what it does is it gives us tools to actually, do certain base level jobs much faster. I don't think so. It changes the world for an individual investor who's actually trying to be more focused on a small portfolio. Perhaps an investor trying to operate in a global market, it actually eases things for them. Because remember, when they are looking for those top 25 stocks across the world to own, it makes sense of them.
Right.
Otherwise, this tool may not be that useful for an individual, barring actually getting information much faster and processing that information. But decision making will be still that individual person who's actually. But for an analyst like my team or salespeople in my team or mutual fund managers, which are owning about 150 or 200 stocks, it can be a boon for them in terms of how to track changes in estimates, how to track changes in commentary, comparing, because sometimes the brain overload or can get overwhelmed. It will also create noise because, Kshitij, people will real time overreact to certain things, and overreactions and overreactions will become higher, I would say, because as the information and first level analysis uh, travels much faster. And if it travels much faster, it reaches much more people. So if you think about the principles of chemistry, the diffusion will be much faster.
Let me also quickly get your perspective on the IPOs, which are, sort of stealing the limelight right now. But not all that glitters is gold. That's also, the past has taught us, or you could say the history has taught us. So what's your golden thumb rule for, separating the hype from truly strong investment opportunities?
I think no major different approach to looking at IPOs, but IPOs, because remember, it's still an auction market.
Yeah. Yes.
And there's a lot of capital in India available.
Right.
A lot of small companies and mid-sized companies or private equity guys want to sell down their holdings into the market to raise capital either for growth or for liquidating their past investments, etc. So, we as an investment bank in my organization, we also are participants as advisors, as bankers to a few of these IPOs. So it's a good thing because investors, as the country becomes mature, wants the business models of today. And you can see that in the 90s and the 2000s, census composition and the Nifty composition have changed. Who would have thought a few years back that a Zomato, which you get a classifieds company, would actually be in the Nifty, and which is the case right now, which is the case right now. The IPOs are a good thing for India. We are sitting at that time where IPOs will be in hundreds. Last 12 months has been a little bit lower activity as compared to the prior few years. So get me right, IPO is the right market, but is it the right valuation every time? And is every business a new fund offering? I would think sometimes we believe that every new offering, new thing is the thing that I want. I think that's what the investor should avoid. We should go back to the same principles. Again, how do I look at this business model? I look at this management already. Right. And are they pricing it at a level which gives me the comfort, or perhaps I can find relatively better opportunities in the market? I think it's like there's an opportunity cost of investing in the IPOs. So I don't consider IPOs to be any different in approach. It can be very different for the institutional investor because remember, this is the only opportunity where they can actually buy into a company for a reasonable bet size. For the individual investors, it's a function of, I would say, they have to still follow the opportunity cost, where the 500 opportunities available in India versus one more opportunity. I'm not saying that IPOs should be avoided. I would say the framework remains the same: quality of management, the gravity of valuations, and comparative advantage, and however it could actually shape up in the future, I think.
So yeah, Okay, now let's come to the heart of today's discussion, which is the framework on investing. Can you walk us through what those are and how they can help retail investors?
I think at the first level is that you need to be actually, as an individual investor or even for an institutional investor, buying certain other quality of investors, you have to have a reasonable time frame. It depends upon you, whether it is 3 years or 5 years or 10 years. One of the words which has come across, and we have also in our asset management business in an organization have a fund called coffee can portfolios, which implies that buy and hold for a long period of time. And I think these sweet spots are about 7 years or so. Number two, imagine if the stock was to be down by about 20, 30, 40, 50%, would you be able to hold it? If you are confident today, I think that's the first side of it. Then now gets to the real crux of it. Take the company's last 10 years of annual reports, 15 years of annual reports, and especially find for the moments of tough time and how management candidly explains that. So go back and read the history of numbers and commentary, look for the behaviors and tough times and good times, and look at how they self-reflected and spoke to their partners called investors. I would say that speaks about the management, the quality, and the evolution. That I think is a very overexploited word, which we also use, the word used called moats or compared advantages.
Right.
No moat is forever. No compared advantage is forever because the environments change. Right. So as I said, go back, read the history of the company, look at the numbers, the evolution, the man behind, the team behind the business. Then go out to understand the compared advantages, how they were built. Is it the brand? Is it the network of people? Is it the unique monopolistic rights that they enjoy? Or perhaps they're innovative. I like to remember how companies remain always relevant in the marketplace. Google has remained relevant. YouTube has remained relevant. Companies, so many companies out there like Adobe has remained relevant to some extent. Asian Paints has remained relevant from to different time, places, or people design their houses, etc. Never lose. And once you're done with all of this, then go and talk about how would it look like the valuation for my holding horizon. If I want to own it for 5 years, what am I paying for the 5th year earnings, which I will face? Never lose the sight of opportunity cost, because I think that's one of the most underappreciated rules also, that opportunity cost matters. Because in the end, GSEC, 10-year GSEC, it protects you slightly closer to inflation or slightly more than inflation. Right. Each intact the value of your money. But investing does expose you to the risk of loss of your capital. So hence, you've got to be thorough. It's simple, but not easy. I think I got it right this time.
Absolutely. Well, then thank you so much for joining and sharing such actionable insights. And until next time, invest wisely and stay invested. Thank you so much for your time, Nitin.
Thanks for having me. Thank you.